Hello, this is John Kvale, and this is our Q1 2022, yes, 2022 newsletter. It's going to drop a little bit early, like tomorrow. It's already in the mail as of today, and that means the video we'll have an all-new intro, all new pictures. I'm still working hard to get better audio and better picture. I've got the camera so good now that I had to keep myself up in the corner because I'm a little bit rugged looking, but I've got the green positive fun shirt on, and I'm outside out back in my backyard, and you never ever know how many odd noises there are, and it'll be interesting to see, from airplanes to a neighbor banging on a fence right now to another one is cutting a log. It's about 5 o'clock in the evening, so the wind has died down. But I digress. So those of you that are newbies, and I also do a monthly video. I do the same thing on the newsletter, and that is I ask you to keep your hands on the wheel since we do this in a video podcasting format, and I will run this through audibly. You will be able to get the point of what we were doing when I wrote all of these articles and the deeper purpose. This is probably going to be a bit long, but that's okay. Hopefully we all have a little bit of extra time, and this will drop tomorrow, which will be Wednesday the 29th. The very first thing that I am going to talk about is the main article, and it's called Anatomy of a Slowdown or Recession. And it's pretty simple, the concept, and I finished the article, and then I went in and gave 3 bullet points. So the 3 bullet points at the beginning are those of us that are 10 years or more from retirement. You kind of look forward to a slowdown because it gives you great things, good buying times. You're buying things that are at a lower level. And you don't know it at the time, but those are really some of your best buys. Those of us that are 5 to 10 year range from retirement, what we do is we slowly make our portfolio more conservative as we get closer to retirement. And the reason being is you don't want to pop out and go, okay, I'm retired, and then the markets be down dramatically. Those of us that are already in retirement, you will most likely have the most conservative portfolio. And so the thing to remember for those that are 5 to 10 years is you're going to have lower prices, but you're still putting in money on a regular basis. Those that are at retirement age, what you have to do is you're most likely not putting any money in. You're actually drawing money. And the most important thing to do is we don't let anyone do this, is you don't come in too aggressive. And so when the portfolio goes down in value, notice I'm very careful not to say we lose money, but when the portfolio goes down in value, you sell the things that didn't go down. Those are generally bonds, and you purchase the things that did go down. You just reallocate. It's like having 2 glasses of water. One's conservative and one's aggressive. When the aggressive one's doing really well, you pour a little bit more into the conservative one. And when the conservative one is doing well, mostly by the more aggressive one going down, you pour some of the conservative stuff into the aggressive, and it evens it out. And that's an agnostic, easy way to basically call it reallocation. Okay, so now let's get into the crux real quick of the article. And the thing that I wanted to do, I have some new software, and so my face is a lot bigger on this than I want. I couldn't figure out how to adjust it, so bear with me. Those of you that are in listen-only mode, I am in a real neat line chart, and this new software is giving me some fun little. It's saying it's a line chart. Okay, so it's a line chart. We know it's a line chart. I pulled this chart out specifically because basically this captured It captured the quick recession that we had in 2020, which was a healthy drop. It was a substantial drop. And those of you that are in listen-only mode, I'm moving down the line. By the way, here comes an airplane. We're getting a little bit of everything. It'll be interesting to see if this new mic is guarding some of that. If not, it's some originality. So that was a substantial drop, and I go into the actual numbers. It was basically a 40 to 50% drop in a very short period of time. However, it was an extremely quick bounce back, and so abnormally so. Then we go back to 2018, where we had a 19.9 drop if you use the S&P 500, and it didn't last very long. Then we go to the beginning of 2018, and we had the the volatility fit, index fit. The reason I'm saying this is because we get used to, what have you done for me lately? You get used to what's happened lately, and that's not really a normal slowdown. Now, you can argue with me that maybe we won't, and I hope that we don't have normal slowdowns. This next graph is, for those of you that are in listen-only mode, is the 7, 8, 9 Great Recession. And that was not a normal. That was even more aggressive. So we go from two extremes. Problem is, it's been a good over 10 years since we've seen a really true recession slowdown, and that wasn't even a true one. I'm not predicting, I'm leading with this, we're not predicting a recession, we're not predicting a bad thing. We do feel like the economy is going to slow down, and somewhere in between these two, the last three short clip slowdowns, and the 7, 8, and 9, which took about almost 2 years to push through the system, is probably where we're going to be. A normal recession lasts about 9 to 12 months. The most important thing, and my editor did a really good job of this, the most important thing that you can remember when it's a recession, those of you that are in listen-only mode, I'm actually going back to the earlier portion of the page. It's near the very end of the recession, the headlines are the worst. And I literally go back, I can't remember which magazine or which outlet it was, but in 2009, those of you that are in listen-only mode, I'm going to the body of the newsletter. In 2009, the recession basically ended, and the bottom of the market was in the March, April timeframe. And January, one of the major major media said, this is just the start. We have 4 more years of this. Well, that would have been almost a 6-year type of slowdown, and that's not normal at all. But certainly, you can't tell people that it isn't going to end. You can just research historical norms, and that alone chased a lot of people out of the market, I am sure. Okay, so I'm going back to the second article, and I'll be much quicker because I know the crux of what I wanted to get everybody on is the fact that we haven't had a normal slowdown in a long time. The second article, our key article, is just retirement planning. So I'm going to pop over to page 6, and I've got a chart here that is from the IRS, and it's all the new levels. I'll let you guys look at that at your own. 2 things though. One thing is the basic 401k withdrawal or savings amount went up a little bit, actually 5.13%, which is a lot of bit. The catch up for those of us 50 and over did not increase. So we've got the new amounts in there. They are there. And if you know sometime coming in 2022 that you may change jobs, stop working, terminate employment for whatever reason, a nifty trick that we like to do is if cash flow allows, have you go ahead and max that 401k out in whatever form or fashion you can. So maybe if you're going to work 9 months, then you max it out over 9 months. If you're only going to work 6 months, yeah, that's a big chunk, but you can try and max it out on 6 months. Do that for a couple of reasons. Number one, oftentimes if you're changing jobs, you're not able to get into the other 401k. If you are able to get into the other 401k, it's confusing to keep you from overfunding it. And lastly, of course, if you're not changing jobs, then it's you're not going to have a 401k. So I'm going to go ahead and skip, in the length of time, I'm going to skip the article that I'm going over right now. And it was a repeat, basically, of the consumer price index. And bottom line is the economy is running at a pretty good clip. The CPI printed a 6.8%. It's very likely next year that we have the peak in now, and the bottlenecks will open up and things will slow down to a more normal pace. So this is actually a repeat article of one that I did on the blog at Street Sense, and it had a lot of good comments. And so I'm going to go back down to a little bit of self promotion, which is fantastic. Our editor actually put this board. Those of you that are in listen only mode, I'm on the second to last page of the newsletter, and it shows all of our different best wealth managers and best financial planners. And I was just surprised when she put this together. It's stunning. It's been very, very flattering. And the regulators have been much more strict on the disclaimers, and they consider this a type of marketing / self-promotion. So I wanted to make sure I got a good, all of the disclaimers in on how this award was done, and what the creation of it was. So I'm going to go to the parting points. I know this is getting long, but you guys, I hope you'll bear with me. The basic final point of this is, in the parting thoughts, I wanted to just remember that the slowdown that we think may occur, or when an inevitable slowdown does occur, it's a normal 9 to 12 month period of time, and the headlines are the worst at the very end. And we just want you to kind of, I made it fun in the article, and I said we're going to dust off the umbrella when it's not raining, when the sun is shining. So went a little bit long. I'm back. For those of you that are in listener only mode, I'm back to page 1. I hope you enjoy the new intro. I hope you enjoy the new intro music, the new pictures. And those of you that can last to the very end, I've got a action picture of myself at the very end. So I'll be interested if anybody has comments on that. So thank you very much, and we will look forward to talking to you in the December Capital Market Review and all of these on a monthly basis. So we're working hard to get everything better. Have a wonderful, happy New Year's, and we'll talk to you frequently next